Stephanie Roth, the chief economist at Wolfe Research. Michael Schumacher is still sticking with us as well. Michael, I want to get your reaction here because, over the last almost decade and a half, we talked to you so often about the bond market and rates action. What exactly did that 7-year auction tell you?
Yeah, it was decent. I think Rick's a pretty tough grader. Frankly, I'm glad he was not my professor back in college. But when you think about what the auction's telling us, to me, it's kind of a natural lead-in to month end. And if you think about all the investors out there who have to rebalance portfolios over the end of the month, and there are quite a few, whether it's pension funds or others, they'd say, well, stocks have done really well this month. Bonds have done poorly. What does that mean I have to do? I have to buy some bonds. This is the last auction of the month. I suspect you're going to see it's already cleared decently. It's probably in the aftermarket going to do okay, but it sets the stage for a pretty decent rebalance over the next, call it 4 to 5 trading sessions into bonds. So I think the very near-term path is pretty good.
All right, we got an idea, Stephanie, of what Michael's view of the economy is right now. I'd like to get your take on this idea that the U.S. is not destined for some kind of a hard landing and that almost has become a base case scenario that the U.S. will either soft land or maybe not land at all and just kind of keep coasting along with this economic growth picture that's modest but might get stronger.
Yeah, we totally agree. We're expecting a soft landing. That's our base case. And for us, the soft landing is 2% GDP and inflation heading back down towards 2%. We don't necessarily need to get GDP running well below trend in order to get there. And that's what we learned last year, that growth can actually stay pretty modest with inflation coming down. And dare I say, inflation actually appears to be somewhat transitory, even though we don't necessarily use that word anymore.
We don't use that word, Stephanie, because it wasn't transitory for a good couple of years there. And it became very, very, very not good to use that term because of it. There's a reason why it's a triggering word for so many people. We did get a couple of hotter inflation reads than some people have expected. We've got PCE coming out later on, right? The Fed's preferred inflation gauge. Do we think as though inflation could not yet be a mission accomplished scenario for the Fed and for policymakers?
The Fed's definitely going to want to see more data, and January was a setback, but we very much believe it was driven by seasonal factors. We were cautious heading into the print, and the data was even stronger than we had anticipated. And this is driven by largely related to annual price increases that tend to go into effect in the month of January, which is catching up to the prior year's strong inflation data. So we don't expect this to continue. We think this is very much a January trend, and then in February and March, things should look a lot more normal. But the Fed will be likely on hold until June, which is when we expect that they're going to be able to cut. By that point, the year-over-year inflation rate is going to be below 2.5%, and they're going to feel a lot more comfortable easing interest rates at that point.